Hey guys, Mariko Berg, realtor with Bridgewell Real Estate Group, and welcome back to the Bridgewell YouTube channel. And today I've actually brought on Ryan Oake with Oake Mortgages, and he is going to be talking me through everything that we need to know about refinancing. There's a lot of people right now that are asking me questions about taking equity out of their home to help their kids purchase a place or potentially buy an investment property. So I really wanted to just dive into the basics of this conversation and kind of put it in layman's terms so all of us can understand. So welcome, Ryan, and introduce yourself.
Thanks for having me. Our company, like Mariko said, is Oake Mortgage. We are partnered with Dominion Lending Centers, Producers West Financial. So we are independent mortgage brokers. We do not work with one specific bank, and we represent our clients to the many banks that we have access to, as well as credit unions and monoline lenders. And we help them with purchases, refinances, transfers, switches, the whole thing.
The whole shebang.
The whole shebang.
Ryan's great. So definitely think about using Ryan. Okay, so let's just get straight into it. Loaded question, but try to put it simply. What does it essentially mean to refinance your home in real estate?
Essentially, what it means is you are unlocking equity that you do not currently have realized yet. So if you purchased a home for $500,000 and you had a 20% down payment, your mortgage would be $400,000. Technically, you are not allowed to access the equity that you own above the 80% mark. So you always have to have 20% of your property value in equity. The rest of it can be loanable. So if your property was $500,000 and it went up to $600,000, you have $100,000 of added equity in your home. You could tap into potentially 80% of that by refinancing and changing your mortgage structure.
Cool. So I was kind of alluding to it in the intro, but investing is just one of the ways that you can use money from a refinance. But like, what are other ways that you see people using a refinance?
Definitely investment properties. One of the other big ones is debt consolidation. So a lot of questions that we get when we do purchases are people are wondering how they can roll their car loan, which might be a used car loan at 5%, 10%, whatever the rate is, and they want to pay that out with their mortgage and roll it into the home. You can't do that on a purchase, but once you unlock the equity in your home and you own it, you technically could do a debt consolidation where you take that unrealized equity out and then you put it towards other consumer debt that you might have. You're increasing what you owe on your mortgage at a lower rate with a longer amortization, but you get to get rid of monthly payments that might be very high on car loans with shorter terms. So debt consolidation for sure. Some of the other smaller ones that are a little more uncommon would be weddings, as well as education and schooling for post-secondary. And then, like you said, gifting money to children who are trying to get into the home market themselves. Parents can gift funds to immediate family members as long as the home is being purchased as an owner-occupied home.
Cool. Yeah, I think that there's like, those are a lot of really great ways to kind of make your life better using the equity of your home. And I think that like in the example that you used, for example, you had like 500K is what you purchased it for, 600K is what it's worth now. So you have 100K in equity, but you have to keep within that loan to value ratio. So in that situation, like we're making the assumption that the real estate market's gone up. So then can you only refinance if the equity in your home has gone up, if the value of your home has gone up? Or say hypothetically, if we were in a stable market and you bought it for 500K and it's currently worth 500K, but you've paid it down over a period of time, is that somewhere that maybe people could refinance as well?
Yes and no. I mean, you definitely could refinance because every portion of your monthly payment is going towards principal. So every time you make a payment, that $400,000 is going to be chipped away at, as well as go to interest. So after a year, you might only owe $480,000, depending on how quickly you're paying it back. It might not be worth it to go through a refinance just to access that $20,000 in equity.
Right.
However, if you go with some of the big banks right now, you can set up home lines with TD. You can set up step mortgages with Scotia, where you have a HELOC on your mortgage registered. The limit is just set at 0 when you close. And you can go into the branch and ask them to increase your limit And as you pay down your mortgage, you are accessing more money on that HELOC that you can re-advance down the road without having to pay the fees and requalifying and going through that process.
Right.
Usually that's for smaller equity that you want to access. If you needed $50,000, $100,000, $200,000 of equity out of your home, generally speaking, it's more advantageous to refinance it because your mortgage interest rate is going to be less than the interest rate on a home equity line of credit.
Right. Okay. So then basically, like if the value of your home hasn't gone up, that might not be the best option for you, but it is an option. And for those of you that don't know, a HELOC is a home equity line of credit. And then if the value of your home has gone up, then that's traditionally where you see most people kind of doing a refinancing and accessing that equity up to that 80% like ratio, right?
Correct. Some of the other reasons why someone might actually refinance as well, monthly payments and interest rate. So a lot of people right now still are in prime minus 0.5. There's some people that are in prime plus half a percentage point for their variable mortgage rate. Some lenders are offering prime minus 1.25 right now. Some lenders or some clients are 3.5 to 4% for their interest rate, and banks right now are offering 3%. For some people, it is advantageous to do a refinance, not simply to change the mortgage balance, but simply change the interest that they're paying on their mortgage and do a brand new term. The penalty to get out of that mortgage could be high, but we always calculate the interest savings for those clients, especially if they're doing fixed interest rate changes, to make sure that that savings in interest rate difference between what they have now and what they could get is going to outweigh the penalty to get out of that mortgage.
Right. Yeah, that's a really interesting thing. I didn't actually think about that in terms of a refinance. So basically just taking advantage of super low interest rates. If you had locked in at a different rate, that penalty that you could be paying to get out of that current one could actually be less than what you would be saving in the long run with refinancing and going with this new rate, for example.
Correct.
Yeah, cool. Okay, so I think that kind of explains like what refinance is, like when people would be open to using it. Out of curiosity, like we have a lot of clients that have purchased pre-sales, for example, and I think this is a really common place to do things is pre-sales. You bought it for $1 million, you wait for 2 years, now all of a sudden it's worth 1.2. Like I literally have that exact thing happening to a couple clients right now. And so is this something that you can tap into as soon as you complete on the home? How quickly is this possible for someone to do after owning a home?
With pre-sales, if you know that there's going to be equity that you can unlock, it's shortly after closing. It definitely makes sense to set up a mortgage with one of the big banks on those kind of step mortgage home line ones where you have a global limit that you can tap into and increase when your property is appreciated, but you necessarily don't need to change what your mortgage balance is. Like I said before, that's going to change what interest rate you pay on the funds that you advance. However, that's the quickest way to access it. And that would be as soon as you getting another appraisal going into the branch after it closes and having your limit increased. As long as your income can qualify that limit increase, can qualify for that limit increase. If you were to just do a standard mortgage as soon as you finish buying, you can do it immediately. The one thing that you want to make sure of, though, is that you're not locked into a long term that has the high penalty.
Right.
Most people don't realize not only is there fixed and variable terms, but there's also open and closed terms.
Right.
So you can actually get an open term at a fixed rate that is going to be substantially higher, but you can pay it out at any time without penalty.
Right.
So most banks have a 6-month or a 1-year term. And a lot of the times the 6 months can be open. You could potentially do a refinance as soon as you close on that property and then access that increased equity in order to make investments, debt consolidation, things like that. The big thing though is it depends on what your equity is in the property. Some pre-sales are only 10% down payment, add in the GST on top of that. Now you've only got 8-9% equity in the home. You wouldn't be able to access any of the appreciation in it because technically the equity you own isn't above 20%.
Right. So it comes back to the loan to value ratio. That's a really good point.
Yeah. So if you're buying a pre-sale, I mean, you could definitely tap into the appreciation right away, but it might just be just as advantageous to take a a larger mortgage at closing and reduce your down payment. So if you're originally going to put down 30%, you could just change it to 20%, hold on to the cash. And if you don't end up using that cash for an investment, you can prepay your mortgage.
Right. Okay. Yeah, no, that makes a lot of sense. So I guess like for
Lots
me,
of different options.
yeah, well, lots of different options. But for me, at least, like what it makes me think is like it's just so important, like communication, like with like you, for example, like as a mortgage broker, like from a client perspective, like really communicating like what your thoughts are, like what your long-term plans are, and building that relationship in advance so that you can properly give them advice on how to structure like the mortgage or the refinance, essentially.
And you know it better than anybody. There's stepping stones in this market. There's the 1 bedroom, 2 bedroom condos. Then there's the townhome purchase. Then there's the detached purchase. And if you're working with someone for their entire life, then there's the downsize back into a 2 bedroom or a townhome. So there's a lot of purchases that people make in this market. And it's really important to make sure that you're making a smart decision on when you're buying a certain property, so that you're not paying more down the road when you go to access equity in your home to help a child potentially buy their first 1 bedroom condo.
Yeah, well, and it's always crazy to me, even like when I hear about like people locking into fixed rates, like from the mortgage broker side of things, like how many people actually break those 5-year fix, and how infrequent it is to last the whole time through is always really interesting to me. But I'm getting on a tangent. So we should move on to the process. So if somebody was looking to do something like this, what is the general process to refinance?
So it's a lot like the process for purchasing a home. So you still have to income qualify. You need job letters, pay stubs, T4s if they apply. You will need all the property documents. With refinancing, obviously there's not going to be an MLS, so you need property tax notice. You will need an appraisal.
Mm-hmm.
We usually pull the title reports for you so that we can show the lender that you do actually own the home and that your current lender is the only lender or bank that has a charge on there for a mortgage. The easier part in terms of documents is going to be bank statements, obviously, because your down payment is your equity.
Yeah.
So all you're going to need to show them is an existing mortgage statement and the appraisal report showing the value. And then the lender can quickly determine what your equity is, which is on the application, essentially your down payment.
Right. So big difference for this one compared to a traditional mortgage is you don't have a down payment because your down payment is your equity. So you don't need to front extra money for a refinance.
Correct.
But my understanding is like you're still going to have like a term, you're still going to have an interest rate, you're still going to have to qualify similar to a traditional mortgage.
Yeah, all the same rates and terms, type of rates still apply. You might have premiums when you refinance with your existing lender.
Mm-hmm.
Chances are, though, if you're refinancing and going to a different lender, they're going to offer you the same rates they're offering for someone for a purchase because they want your business. You can do 30-year amortizations because now you're a conventional mortgage with 20% at least in equity or down payment. And then you can also do the variable or the fixed terms 1 through 5 years. Well, you can go up to 10 if you want, but that's rare.
Okay, perfect. Well, I think that you just answered one of my questions kind of in that is that a refinance doesn't have to be done through the same institution. It can be done through a different institution if you want to.
Correct. And it's usually preferred to go to a different institution, especially through a mortgage broker, because if you go into your own bank and ask them to do a refinance, you're taking whatever they're going to give you. You don't really have another option to go to because RBC is not going to help you go get a mortgage and refi with TD Bank.
Yeah.
Because now they've lost you as a client for their mortgage.
Yeah.
It's really important that you do make sure that you do look at all the other options when it does come to a refinance, because there are some lenders out there that can help cover costs, which we might get into here in this conversation. But a lot of the times you're going to need to pay for a notary or a lawyer. You're going to need to pay for paperwork. You're going to need to pay discharge for the existing mortgage. Some lenders want your business that a lot, so much so that they will give you credit if you move your mortgage to them on a refinance.
Okay. And so let's just get into costs then. Like, what are the costs to refinance? I mean, aside from the obvious being like interest rates and all of those kind of things, lawyer fees, what else could we potentially be seeing for the cost to refinance?
The biggest one is going to be any potential penalties. So you're either going to have 3 months interest penalty or an interest rate differential. It can range anywhere from a couple $1,000. I've seen some higher than $20,000.
Crazy.
It all depends on the amount that you're owing when you break it, how long you've been in that term, where rates are now compared to when you got your original mortgage. And those are the big items that are going to go into the penalty. The other costs, like you said, notary or lawyer, if you are changing who's on title, what the mortgage balance is, who the lender is, you need to re-register all that paperwork with the land title office through a notary or lawyer. If you are removing someone during a refinance or taking equity out, there may be capital gains tax, there may be property transfer tax if your co-signer is not an immediate family member or parent. So there's a lot of different costs that can go in there. Those are the bulk of it. Those are the bulk costs. Some smaller ones like discharge fees for getting out of your mortgage might be a couple $100, things like that.
Okay. And then like if somebody's wanting to start this process, like, first of all, who's involved in it? And like, where would they start to kind of gather that information for how much things cost? Is that something like, oh, I'm thinking about refinancing my home, I'll call Ryan and you can get that information for me?
That's a good question, actually. The first thing that we almost always tell people is you need to get your current mortgage statement from your lender. We need to know when your maturity date is, what your balance is, what your rate is, and you really need to contact them to get your penalty. We can try and estimate it, but if you're in a fixed term, the interest rate differential penalty, it's such a complex formula where you're taking posted rates versus discounted rates at a time where if we weren't accessing them for you, we might not even know what those rates are. And the lender's only going to release that information to you. Even if we placed you with, say, a TD Bank is not going to give us penalty information for your specific mortgage. So contacting the bank to find out what your potential penalty would be, and it changes daily by a small amount, but it changes daily. Just finding out a ballpark what that cost might be is the first step. Cool. And then we can determine whether or not going with a different lender at a lesser rate is going to be more advantageous. Or if you need to take equity out, how much more is it going to cost you to go with a different lender at a higher rate with your penalty?
Okay, awesome. So that's step one. And then in terms of like the realtor side of things, just so everybody knows, like we're not overly involved in this process when it comes to refinancing, but obviously if you are pulling equity out for the purchase or for the reason of investing in the real estate market moving forward, that's more when we would get involved. And then I think very obviously like a lawyer and notary is involved. And then maybe if you're talking about capital gains and things like that, potentially an accountant. But is there anyone else you can really think of, or that seems to be it?
In terms of someone that needs to come into the process, no. I mean, it's pretty straightforward, to be honest. It can be done as quick as a month, even sooner. It depends on who the notary or lawyer is and how slow the lender is in getting your mortgage information to your new bank. But essentially you go to a mortgage broker, determine what you pre-qualified for to access in a refinance or take out of your property. If it makes sense, we collect all the income documents. We go to get it approved with the lender. Once that's all signed off on and done and the appraisal is complete, it goes to the notary. They contact your existing lender and they get all the information from the new one. They put together all the paperwork, it's signed and executed. So it can happen relatively quickly. Like I said, it's just a matter of whether or not you've got everything in order between income documents, existing mortgage statements, and everything else that needs to get collected for the lender to approve it.
Okay. And I just quickly want to touch on income here. So is this something that can be taken advantage of by people that do not have an income, say that are retired, or do you always have to have an income with this one?
You will almost always have to have an income. The only time where you wouldn't need to have income on paper is if you were over the age of 55 and you wanted to go with a typical bank like Home Equity Bank who does chip reverse mortgages, where essentially they're going to look at the equity you have in your home, your age, and they would give you either installments, they will pay you every month, or they will give you a lump sum amount of money and you actually don't pay them back each month. You just pay them a balance which is due when your home is sold.
Right.
So it's a great option for people who, maybe they didn't save as much for retirement and they want to do a refinance in their home, and the equity that they have is going to pay their lifestyle for the next 20, 30 years. Or I've seen it a lot of times where they want to give out early inheritance,
Mhm.
and they take the equity out of their home and give it to children, grandchildren. And then when the estate is settled, the lender just takes whatever's owed and then the rest is distributed. So there's definitely options for people who do not have income. But generally speaking, with banks, if you are going to go through a refinance, you have to have some kind of documented income.
Yeah, even if it's just something, and then maybe Ryan can work his magic and try and find something else that works instead. Just some kind of income, I guess. Okay, and then last question that I have, is there any, or like anyone that should not consider this option? Like who would not really be a good candidate for a refinance?
Well, chances are someone's coming to you for a refinance for either debt consolidation, or education, helping children pay for a wedding, helping kids get into their first home. Usually strong, responsible reasons. They want to clear debt. They want to help somebody else access more equity into a home, get their foot in, etc. The time where it gets a little sticky is where someone's constantly taking on debt to buy highly depreciative assets, and they just are not good at managing their finances. The worst thing you could see is someone go to refinance their home and they leverage themselves as much as they can, and they're buying high interest rate. Like, there's no reason why somebody couldn't refinance their home, take that equity, and go buy a $200,000 sports car with 50% down and take a 10% loan on the car,
Right.
because they did the mortgage refinance first.
Right.
So it's, if someone's very, very poor at managing their debt and cannot help themselves if they have ease of access to their equity, it can be a very, very dangerous situation, especially if the home that you're refinancing is your owner occupied home, which might not be only your place. It might be a wife, partner, children, etc.
Yeah, there's a lot on the line at that point. So if you aren't the best at managing your money, maybe don't consider this. But I think that you went through a lot of other options where it is entirely appropriate and super, super helpful. Like I see a lot of parents taking equity out of their home to help their kids buy in this like extremely difficult market, and a lot of other reasons like you had touched on as well. So definitely one for everybody here to be aware of. And I think that kind of sums up the basics for refinancing. Obviously, Ryan can go into it in a lot more detail. And if you are wanting information on like your specific situation and for Ryan to kind of unpack that, then definitely reach out to him. I'll leave his contact information in the description in this YouTube video. And definitely, if you guys are thinking about investing in real estate or looking into what options there are in the real estate market, you can reach out to me as well. But thank you so much for watching. And we hope that this video was really helpful for all of your refinancing questions. If you do have any other future videos that you want us to cover, then definitely leave whatever you're thinking in the comments below. We'll definitely take a look at it and we'll consider them for future videos. So thanks so much, Ryan, for joining me today. And we really appreciate your time.
Thanks for having me on, Mariko.